The Reserve Bank of India has released the first batch of sovereign gold bonds, which can be subscribed until the 23rd of June. Now, you might be wondering if it's better to buy these bonds instead of physical gold. Well, sovereign gold bonds offer a great alternative to holding gold in its physical form. When you invest in these bonds, you eliminate the risks and costs associated with storing physical gold. You are also assured of the market value of gold at the time of maturity and receive periodic interest. Additionally, there are no making charges or concerns about purity as you would have with gold jewelry. The bonds are held in the books of the RBI or in demat form, eliminating the risk of losing the bond certificates. If you are interested in investing in these bonds, you can get the application form from the issuing banks, SHCIL offices, designated post offices or agents. You can also download the form from the RBI's website, and some banks may even provide an online application facility. Now, let's talk about the minimum and maximum limits for investment. The bonds are issued in denominations of 1 gram of gold and multiples thereof. The minimum investment required is 1 gram, and individuals can subscribe up to a maximum limit of 4 kg. For Hindu undivided families, the limit is also 4 kg, while trusts and similar entities specified by the government can invest up to 20 kg per financial year. If you are applying jointly, the limit applies to the first applicant. You might be wondering about the rate of interest and how it will be paid. The bonds carry an interest rate of 2.50% per annum on the initial investment amount, and this rate is fixed. The interest will be credited semi-annually to the investor's bank account, with the last interest payment made at maturity along with the principal. If you prefer online applications, good news! You can apply online through the website of listed scheduled commercial banks. And if you apply online and make the payment digitally, you'll get the gold bonds at a price that is Rs 50 per gram less than the nominal value. When it comes to redemption, on maturity, the gold bonds will be redeemed in Indian rupees. The redemption price will be determined based on the simple average of the closing price of 999 purity gold over the previous 3 business days from the prepayment date, as published by the India Bullion and Jewellers Association Limited. Now, can you encash the bond whenever you want? Although the bond has a tenure of 8 years, you can encash or redeem it early starting from the 5th year from the date of issue on coupon payment dates. If you hold the bond in demat form, it can also be traded on exchanges or transferred to another eligible investor. Lastly, let's talk about the risks associated with investing in sovereign gold bonds. There is a potential risk of capital loss if the market price of gold declines. However, it's important to note that even if the market price decreases, you won't lose in terms of the units of gold you initially paid for. Overall, sovereign gold bonds are considered more attractive than other gold investment schemes due to their convenience, assurance of market value, and the elimination of storage risk and costs.